My name is Ahmad Syami Akif bin Raimi.
My name is Arif Azimi bin Abdullah.
My name is Muhammad Zahin Amza bin Abdul Hadi Kamil.
My name is Muhammad Azmi Faris bin Amri Fazri.
My name is Muhammad Khairafi bin Muhammad Amir Rafai.
In today's global business environment, many companies operate in multiple countries, creating the needs for transnational audits. A transnational audit involves auditing a company with operations in more than one country and requires coordination between auditors from different jurisdictions. With the growth of international trade, digitalization, IFRS adoption, and global supply chains, transnational audit have become an important contemporary development in the auditing profession. Differences in accounting standards are one of the main challenges in transnational audits. Multinational companies prepare financial statements using different frameworks, such as IFRS, US GAAP, or local GAAP, depending on each country's regulations. This makes financial information less comparable and more difficult for auditors to evaluate. Auditors must understand several accounting systems to interpret subsidiary financial statements and ensure accurate group consolidation. These differences increase the risk of misstatement and require additional time and technical expertise, which can affect audit quality if not properly addressed.
Next, another major challenge in transnational auditing is coordination between the group auditor and component auditors. Even though many audit firms operate under global networks, audit quality and methods can still differ between countries. The group auditor gives the final opinion on the consolidated financial statements, but much of the audit work is done by component auditors in foreign subsidiaries. Problems arise when communication is unclear, instructions are not properly followed, or audit documentation does not meet international standards. Time zone difference and different working cultures can also slow down coordination. When coordination is weak, important risks may be missed, leading to undetected errors and reducing the credibility of the group audit. Next is cultural and language differences. Business practices, management attitudes, and communication styles vary across countries, which affects how auditors interact with local staff and interpret information. In some cultures, employees may be reluctant to share sensitive details, while in others, strong hierarchies can limit open communication. Language barriers can also cause misunderstanding when reviewing audit evidence, financial records, or internal control explanation. These challenges may reduce an auditor's ability to apply professional skepticism and identify red flags. Without strong cultural awareness and strong border communication skills, auditor risk misinterpreting information and overlooking critical audit issues.
Transnational audit plays a crucial role because they help make financial reporting for multinational companies more reliable and trustworthy. As global business grows, stakeholders like investors, regulators, creditors, and international partners need a financial information that is consistent, comparable, and accurate across borders. Since multinational companies are complex, the chance of reporting inconsistency become higher, which makes strong audit oversight very important. Transnational audit help confidence in global capital markets by showing that the consolidated financial statement reflect the true economic position of the company, no matter where it operates. They also reduce information asymmetry between companies and stakeholders in different jurisdictions. Without strong transnational auditing, multinational companies will face more risk of financial manipulation, fragmented reporting, and lower investor trust. Therefore, transnational audits are essential for corporate accountability and global investment decisions.
Analysis and evaluation for adoption of IFRS globally. Global adoption of IFRS has made financial reporting more consistent and improved the comparability of multinational company statements. This helps auditors work more efficiently across borders, but full harmonization is incomplete. Major economies like US still use their own standards such as US GAAP. As a result, auditors continue to face differences in reporting rules. Overall, IFRS has improved the audit comparability, but coexistence of multiple standards still creates extra work and judgment for auditors. Analysis and evaluation for increased oversight by global regulators. Global regulators like PCAOB, AOB, and FRC are increasing cross-border inspection, which strongly impacts transnational audits. By reviewing work done in different countries, they push audit firms to improve quality control, documentation, and consistency across their global networks. But challenges remain. Some countries limit foreign inspections, and regulatory requirements for still differ across jurisdictions. So while global oversight has boosted transparency and raised audit standards, the difference between regulators continue to limit fully consistent cross-border audit regulation.
Technology and ESG reporting are reshaping transnational audits. Advanced tools like AI, data analytics, and cloud platforms help auditors analyze large global datasets faster and share evidence across countries, improving audit quality. However, not all audit firms have the same technology, and data privacy laws limit what can be shared, creating challenges in global coordination. At the same time, the rise of ESG reporting requires auditors to verify sustainability information such as carbon emission and supply chain practice. ESG data is often inconsistent and less reliable because different countries use different frameworks and measurements.
Transnational audits face many challenges that influence audit quality. Inconsistent audit standards across countries cause differences in audit procedures, documentation, and judgment. This creates a risk when group auditors rely on component auditors who use different levels of rigor. Regulatory barriers like limits on data access and cross-border information sharing may stop auditors from getting enough appropriate audit evidence. This increases audit risk. Coordination problem between group and component auditors can lead to weak communication, delayed reporting, and a poor understanding of local risks. Cultural differences also make risk assessment harder because auditors may misinterpret behaviors or miss red flags in another cultural context. Technology gaps between member firms affect standardization, and cybersecurity rules may limit digital evidence transfers. Overall, this challenge show that transnational audits need more specialized skills, stronger communication, and more professional skepticism. Without managing these challenges, audit quality may drop, and this reduce trust in multinational companies.
So, in conclusion, transnational audit has become a crucial development in modern auditing as business expands globally. Despite its importance, it brings complexes, challenges such as regulatory differences, communication barriers, and ethical risks. To maintain audit quality and credibility in global markets, auditors must strengthen their professionalism, skepticism, and cross-border collaboration.
Here, the recommendation for the transnational audit. First of all, strengthening coordination between international audit teams. This means the group auditor should communicate clearly with auditors in other countries so that all audit work is consistent. Second, auditors should enhance their understanding of local laws and regulations. By knowing each country's tax and reporting requirements, the audit will be more accurate and compliant. The last but not least, companies should use secure digital platforms for data sharing. This allows audit documents and evidence to be shared safely across borders while protecting confidentiality. This recommendation will help improve the quality and reliability of transnational audit.